Hello class, today we're going to be talking about the types of accounts that is commonly maintained by a business, okay? Let's get started. Okay, now, aim of a business. What is the aim of a business? Most business exist with the main aim of making a profit. So, in the process, they carry out different transactions daily as part of their business activities. So what do we mean by transactions? Transactions are the activities carried out by a business which has a monetary value, okay? Take note the word monetary value, okay? Now, questions. What are some activities that the business perform in running their business? Can you have a think about this? Yes? Okay, let's have a look. Okay, what are the activities of a business? For example, business transaction or rather if it's easier for you, what are the activities that the business commonly do in a business every day, day in, day out? So for example, okay, buying and selling of goods, make payment to the suppliers after they bought the goods, pay for expenses. No, for a business, what do you think are the common expenses of a business? Yep. Okay. So for business, for example, you may think of a business like a computer shop. They have to rent the shop, they have to pay for the salaries of the worker, they have to pay for the electricity, they have to pay for the water, the lighting, the insurance. All these are the expenses of business. Or maybe they can receive the money from the customer, from the sales, and so on, okay? All these are what we call business transactions, okay? These are the activities that the business do in their running or in a daily on a daily basis, okay? And all these typically involve, okay, money, okay? They have a monetary value to it. Account. So account is used or is open to record business transactions, okay? So as we said, because the business have a lot of transactions, we will need a way to record it. So we open up something called an account, okay? We keep an account for the business transactions, okay? So an account is used to record business transactions. Okay, so what are the types of accounts a business can have? Okay, so this brings us to the classifications of accounts. Business transactions can generally be classified into 5 categories of accounts. So they are number 1, assets, number 2, liability, number 3, owner equity, number 4, expenses, and number 5, income or revenue. Okay. Now, assets. Assets are resources of value owned. You see the keyword owned by a business, okay? So example of a business asset can be motor vehicle, furniture, building, machinery, cash. This can be cash in hand or cash at the bank. Stock, okay? Say for example, business a businessman, his business is about operating a computer shop, okay? So his stock will be stock of computers, okay? Debtors, okay, now this debtors is someone who owes money, okay? For example, the computer shop, he sell the computer to the customer, but the customer has not yet pay the money because it's the computer shop sell to him on credit, he not yet pay. So that customer is called a debtor, okay? Because he is owing us the money now because he not yet pay, okay? And so on, okay? So you can just think to yourself like this, just like your parents, like because you don't currently have any assets. So for example, like your parents, what are the assets that your parents could have? Maybe a car, a house, office equipment, furniture. So same like a business. These are the assets a business own, okay? So we can have the building, the premises. So for us, we can have a house, motor vehicle, machinery, office equipment. All these are called office equipment because they are being used in the office. Okay. And then even cash. It can be cash in hand and all the cash at the bank. Okay, now liabilities. Liabilities are the amount owed by the business. Okay, owed by the business. They are the like debts. Okay, so what are the debts of a business? For example, like bank loan, bank loan. Okay, bank loan. To put it simple, is for example like a business they want to start a business and then do not have the money to start the business, so probably they could get a bank loan, like say 50,000 from the bank, and then they will have to pay interest, okay, on the loan amount. Okay, so this is called the bank loan. Okay, borrowing money from the bank. Okay, bank loans. Bank overdraft. Bank overdraft is to put it simply is just like when the business is taking out or paying more than what it has in the account. Okay, this is like a facility taken with the bank. Okay, when the bank allowed the business to withdraw, maybe to withdraw more than what it currently has in the account. Okay, but then after that the business has to pay back, of course, with an interest. Okay, this is sort of like a facility with the bank. Okay, when you temporary withdraw more than you have in the account. And creditor. Okay, just now we talk about debtor. Debtor owes us the money. Okay, so he is the asset, whereas creditor is someone we owe the money to. Okay, for example, like ABC company supply to us the computer, but we not yet pay to the ABC company. So ABC company is our creditor. We owe creditor is someone who we owe him the money. Okay, creditor. That's why he is the liabilities. So bank overdraft are the liabilities and bank loan are the liabilities. Okay, now let's move on to capital. Capital refers to the money or assets bring into the business by the owner. Okay, so when the owner wants to start a business, he can bring in money, or he can bring in instead of money, he can bring in assets. Like he can bring in instead of cash, he can bring in like maybe a motor vehicle or furniture to start the business, and this are referred to as the capital. Okay, anything bring into the business by the owner are called the capital. So money bring into the business. Expenses. Money spent on items for a business to carry out its activity. Just like for, you can think of yourself, like for you, your parents, what are your expenses? You pay for rent, you pay for insurance, you pay for school fees, all these are expenses. So what are the expenses of a business? Rent, interest, electricity, insurance, salary and wages for the workers, lighting, and so on. Okay. How about revenue? So just now we talk about expenses is something which we pay and spend on, and revenue is money received. Okay, it's like an income. Okay, so money received from sales or service given, because sometimes a business is not just about selling the goods. It can be about a service based business. Okay, like for example providing a car wash maybe. Okay, so that is the source of income. Okay, source of revenue. So money received from sales or service is a source of income. Example, sales, rent received, interest received, commission received. As you can see just now, we also have rent, interest, and commission. But how to differentiate expenses and revenue is that you see the word receive behind. Then we can almost automatically know that this is a revenue to us. Okay, if you do not have the word receive here, just rent, then it will be expenses. If it's just interest, then it will be an expenses. If it's just commission, then we'll assume that it's an expense. Okay, so with the word receive behind is a revenue. Okay, so asset versus expenses. What do you think are the difference? What can you tell me about the two? What do you think are the difference? How are they different? Okay. For me, I would generally think that asset is mostly acquired to be used in the business for a more long period of time, a long duration of time. For example, you bring in motor vehicle, you bring in furniture, office equipment to the business. You are going to use it for a certain long period of time, okay? These are called the non-current assets, okay? Whereas for expenses, it's more like what you have to pay monthly, okay? For example, in your business operation, like you have to pay for the lightning, you have to pay for the salaries, you have to pay for the insurance. These are more like money kind of thing, whereas this one is like one-off purchase. For example, you purchase the motor vehicle like 30,000 and you're going to be using it in the business for a long duration of time, 5 years, 3 years, 10 years, whereas this one is more like money every month basis. Okay, you have to pay, okay, for the salary, for the lightning, for the electricity bills and so on. Okay, so this is what I think is the basic difference between the two. So I think that's all for today's lesson. Thank you.